You're saying you were underweighting U.S. equities. You're overweighting China and Europe. Is that right?
Yeah, that's right. They had both been at low levels of growth, and we were seeing evidence of a rebounding growth this year. And for the most part, they seem to be stomaching at least the initial assumptions on what we were seeing as far as tariffs. I do think we have to go and reassess how significant these tariffs are and what they can do on the global scale. I think increasingly it does look like maybe there's nowhere to hide. The U.S. seems greatly affected, but I'm not really sure. I'm not quite as confident that we're going to be able to find other places in the world that won't have ripple effects there too.
All right. I was going to ask you about gold. Let's talk about fixed income first. That's potentially one of the places where you could hide. And it's probably a good time to take a look and catch up with the U.S. at 10. I think it's taken a bit of a knock, at least on the yield, down about 5 basis points or so. We're in the 407s, if I'm not mistaken, or 409s. So we have that chart. Give viewers a look. We're up at 412. Oh, goodness. Okay, now we're sub 407. We're at 406 and a change. And, Tony, you think that's likely to go lower?
Yeah, so I think those who are buying bonds are having a tough time in sort of assessing what's going to happen at the Fed, right? The growth outlook is definitely under pressure right now, and hence that would put pressure on the Fed to cut rates. But the inflationary outlook is also quite troubling, and therefore, I think that really puts the Fed in a tough position. I can see the way yields are breaking to the lower, and therefore it makes sense being concerned about growth. But I do think there's a limit how low yields can go because ultimately I think the Fed is going to be somewhat constrained. Their initial comments have been that they do look at tariffs as being transitory, which is a dangerous word for them. But also, I think all the more so now that the scope of these tariffs are so large, you have to be concerned about, the ripple effects as prices and everything starts to go up so much. Wages people are going to be demanding more in wages. And then you have this, non-transitory effects into inflation.
Yeah, Tony, while we've been talking, we're also showing folks that the 2-10 spread, that's narrowed significantly as well. We're at about 26, 27 basis points on that. So curve is flattening even further. Not sure whether I'm talking about inversion, back-to inversion sometime soon or not. But look, in terms of places to hide, given the fact that, even if this was the worst possible outcome, right? It is even worse than that. It's just a starting point, right? Where we go from here, we don't know, but we do know this isn't the end. It's just the beginning. Given that, even with gold at fresh record highs earlier this morning, 31.65, is there more upside? And do you like that as a place to hide?
So directly on gold, I would say, yeah, we still like gold, and all the more so on a day like this with so much confusion. But I would add, I think to carry on to the point you were making, I think is exactly right. I think the markets were hoping for some sort of clearing event where at least we know what the tariffs we're dealing with and businesses can start to plan around it. But I think what's happened now is that I don't think the uncertainty is going to go away. Now what I think economists around the world are going to be looking at is, can the global economy really hold up to this amount of tariffs without creating a recession? And I think at the very least, everybody is increasing their recession odds, even if they aren't making it a base case yet. I would have said at the beginning of the year, I had close to 0% assumption on recession odds. And in-house, we had already raised it to 30%, and that was before today. We may have to raise it a little bit more. But I think the uncertainty hasn't gone away because of this. The uncertainty is going to be profound because we're going to be watching economic data very closely now.
Yeah, because jobs report coming up on Friday as well. It's probably the next key data point. But in terms of watching markets, Tony, we've been talking about how, equity markets, a sell down we've seen, whether it's the S&P, the NASDAQ, the MAX 7, Tokyo stocks, or whatever, it's been on lower than average volume, suggesting that there's a lot of money sitting things out, right? Waiting to see what happens on the tariff front, how high the tariffs go, whether they get negotiated down, whether they're countermeasures or retaliation, counter strikes, as it were. So that's maybe not a good sort of indicator to follow, because then volumes can always skew and exaggerate price moves. Currencies and also yields, are they a much more accurate reflection of the potential risks that could lie ahead?
Yeah, I do look at currencies and yields because equities can be very volatile. But the fact that there's been a lot of corroboration of the trends that we've been seeing in especially yields, I think that sort of just really gives evidence that the concerns about the global economy are really real, and hence we've been seeing big moves. If there's one area that we've been watching that hasn't really been as worried, it has been credit spreads. And I think they've been largely remaining fairly tight. And I think in the next few days will be interesting to see how those behave. I would imagine some pressure on credit spreads at this point. I think the anxiety is being ratcheted up another level.